So here we are in objective 3.3, depreciation. We've done accruals and deferrals, and now we're down to depreciation. One thing about depreciation is it's always just going to be one expense account. Depreciation expense. Always depreciation expense. So we'll write it down here as our debit. Expenses are debits, depreciation expenses are adjustment. So we'll put that account there. In the first journal entry, this is the setup. We're going to purchase a $60,000 Bobcat. I'm going to put it in, instead of equipment, just property, plant, and equipment. That's really the catch-all account that we'll use most of the time. And you'll see it on financial statements. And the abbreviation you might see me use in the future is property, plant, and equipment. Notice that this is increasing an asset account, a debit to an asset. And since there's no note, we're assuming they paid cash. This is a decrease to an asset. So this purchase does not change total assets. All right, now before we get to calculating the amount, the credit is a different type of account called accumulated depreciation. So this account, I told you that assets have a debit balance, and that is true, but this account, since we're working with it, we're going to get more into it in Chapter 5, but I will mention that this is what's called a contra asset account. It's classified with the assets, but it has a debit balance. Okay, so we're going to debit accumulated depreciation. So that's a contra asset account. You can just stick that in your back pocket, and we'll come back to it in Chapter 5, which we skipped Chapter 4, so it's the next chapter. Now we're going to talk about the amount. So this thing was bought on the 1st, so we don't have to do a partial year adjustment. But depreciation expense equals the cost of the item, historical cost, minus the residual value and this is a straight line over the useful life. In this case, we have 60,000 minus 10,000 divided by 5, and that will equal 10,000. Okay. What can I say about accumulated depreciation? 60,000 is property, plant, and equipment, and accumulated depreciation is 10,000. If you put those property, plant, and equipment net, which means net of accumulated depreciation, then it's 50,000. Oops, 60, this is 60. So what this is telling you, if you had 60 was the original cost, but now it's on our books net of accumulated depreciation for 50. Oops. It would tell you that we've used 10/6 of the useful life of this item. Okay, more on that later, but why do we have this accumulated depreciation account? It's to tell us how much is used up. For right now, when you do the adjusting entry, you need to know two things: depreciation expense debit, accumulated depreciation credit. Okay. And that should be it for... No, it's not. Of course it's not. Why would I do that? Here's the same case, except I wanted to do a partial year. So depreciation expense equals depreciation expense per month times number of months in this current cycle. So it's 60,000, same as before, minus 10,000, divided by 5 years times 12 months per year. And since in this second case we bought it in July, so it's half a year or 6 months, this would be times 6. Okay. So we have 833.3 repeating times 6 equals 5,000. All right, does that seem correct? So we have, yes, because we had a full year 10,000, so a half a year should be 5,000. Okay, so that's the amount, but we know what the journal entry is going to be because it's depreciation expense. Depreciation expense debit, accumulated depreciation credit. And we just calculated the amount. It's half a year. We could have noticed that from above, but we kind of wanted to have a general approach here. And just to be complete, we'll have P, P, and E, and cash, 60,000, 60,000. And that should do it for depreciation.